That's what most people think trading looks like, and that's pretty much what it feels like to me when I'm doing it, like you're in some sort of matrix thing, but you also know what's going on when you're really into it. Throughout this course, I will teach you my 10 trading strategies that you need to know in order to be a profitable trader, so in order to make money in crypto. And also you will learn what the blockchain technology actually is, how crypto wallets are used, crypto exchanges. I will also explain briefly crypto mining, staking, the types of platforms you can use from Coinmarketcap to Tradingview, setting up price alerts, watch lists, the different types of trading from day trading to scalp trading to leverage trading, and obviously the most important thing, I will teach you about the patterns and various technical analysis tools that you need to use in order to predict the price action of a coin, and once you're able to do that, you will be a profitable trader. So from support and resistance to different type of candlestick to volume, moving averages, and the relative strength index or RSI. There will be much more in the course, so I hope you will spend this hour or two with me on this course and learn hopefully a lot of new things that you didn't know before. So with all that being said, if you don't get this course, you're definitely missing out on some of the tips and tricks that insiders usually don't want to share, but as I gathered knowledge from here, from there, from all types of places all over the internet, I have gathered some pretty cool and useful information that you'll definitely miss out on if you don't get this course. So thank you for taking the time to even watch this promo video. I really appreciate you. As I said, an hour to two of entertaining educational content. So with all that being said, I hope I have convinced you, and I'll see you on the course. So over the years, trading has become second nature to me. Reading the market is something I try to do every minute, every hour, every day. By doing this, I picked up a lot of methods from various places. Some methods don't work at all. Some methods work just sometimes, and then there are methods I like to call the secret methods, because they just always work. So in this first section, I will just introduce you to the course. For everyone who is new to crypto, I will explain in detail what the blockchain is, explain crypto mining, crypto wallets, crypto exchanges, and then we'll go on to the more advanced things, like using websites like Tradingview, Coinmarketcap, setting up watch lists and price alerts so you don't have to actually watch the market 24/7, and just a lot of tips that are really helpful in your journey to become a profitable trader. I will explain what the different types of traders are and all the different types of trading you can do. Then we'll start learning technical analysis, reading the market, and using different types of indicators to help us do just that, like the MA, moving average, or the RSI, the relative strength index. You'll learn about different candlestick types, effective price analysis patterns, uptrend versus downtrend, breakouts, market cap, tokenomics. So don't get it twisted, this is a short course, but you will learn everything you need to know in order to become a profitable trader. So welcome to the course, and you've made a good investment today. So what actually is a blockchain? I will try to explain this as simple as possible. For those of you who are crypto newbies, this is going to be perfect. The first few lectures are just about learning what the blockchain is, what the crypto wallets are, and what crypto exchanges are. If you already know all this and want to get straight into trading, you can just skip these first few lectures and go straight into the trading ones. Now, for those of you who are interested in learning more about this, here we go. What actually is a blockchain? A blockchain is a special type of database. It differs from regular databases in the way that it stores information. Blockchain stores data on specific blocks that are later chained together. As new data comes, it is entered into a new block on the blockchain. Once the block is filled with data and can't take any more, it is chained to the previous block on the blockchain, which makes the data chained together in a chronological order. Different types of information can be stored on the blockchain, right? It is mainly used as a ledger for transactions, but anything from a government ID to JPEG files can be stored on the blockchain, where NFTs come in. NFTs are JPEG files or songs, or really anything you can upload that is stored on the blockchain is an NFT. But as I said, the most common use is for storing information about transactions. In Bitcoin's case, blockchain is used in a decentralized way, so that no single group or individual has control. Rather, all users collectively retain control. Decentralized blockchains are immutable, which means that the data entered is irreversible. In Bitcoin's case, the transactions are permanently recorded and they're viewable to anyone. So I can right now literally open the Bitcoin blockchain and just look at all the transactions that are happening in real time. I can even see all the wallets. Now, I don't know which wallet belongs to whom, but I can see all the transactions, and you can as well. Anyone can, which is kind of the whole point. It is totally transparent, but at the same time, everybody keeps their privacy. Now that is in the most simplest terms explained, just in case you didn't know. Now what is a crypto wallet? Cryptocurrency kind of has that irony in naming things, whereas they named something a coin when there is no actual coin. It's not a coin, it's something else entirely. Same goes for crypto wallets. It has absolutely nothing to do with the actual wallet, except for the fact that you can view your currency on your software wallet. But other than that, it's definitely not a wallet. It just named that. A crypto wallet is storing your private keys, which in turn interact with various blockchains and are able to pinpoint the location of your crypto. So you need a crypto wallet in order to store cryptocurrency. The currency don't get stored in any specific location, and they don't exist in physical form at all. All that exists are records of transactions stored on the blockchain. When someone sends you cryptocurrency, they're essentially signing off ownership of their coins to your cryptocurrency address, your wallet address. The transaction is only signified by the transaction record on the blockchain and a change in balance on your cryptocurrency wallet. Right, now that that's out of the way, wallets can be categorized into three things. We got the software wallets, we got the hardware wallets, and we got the paper wallets. Now, I will not talk about paper wallets at all. It'll be way too confusing. I will just talk a little bit about hardware wallets, a little bit about software wallets. Software wallets are installed and downloaded on a specific device. It can be a mobile phone, it can be your PC, it can be your laptop. And they're only accessible from said device they were downloaded on. Very high level of security. However, if your device gets hacked, if your PC gets hacked, your wallet and your currency, your crypto can be compromised. Now, I personally do store crypto on software wallets, but I also have a hardware wallet. Hardware wallets store the private keys of your wallet, that we already talked about the private keys, right? They store the private keys on a hardware piece of technology like a thumb drive. Like for example, this right here. This is a ledger and it's a hardware cryptocurrency wallet. Now right now it's totally empty. I don't have anything on it since it's trading season right now. I'm trading with all my assets, but this is what a hardware wallet looks like, pretty much just like a flash drive, a USB. And just like a flash drive, like a normal USB, no one who is not in this world would be able to tell the difference. When I say in this world, I mean the cryptocurrency world, not Earth. That was supposed to be a joke. Right, now how do they actually work? Well, they're totally offline. They're storing your keys and your crypto offline, but they make the transactions online. So the fact that they're storing the keys offline makes it exponentially more secure than anything else out there. So how does it actually work? Well, you plug in your hardware wallet in an internet accessible device, any laptop, PC, phone, whatever. While you also have options to connect your hardware wallet to your software wallet with various keys and pins. Either way, you plug in your device, you enter a pin, you send the currency, and you're done. That's as far as we're gonna touch the crypto wallets for this course. So what exactly are cryptocurrency exchanges? Cryptocurrency exchanges represent traditional finance markets, or rather I should say traditional centralized financial markets, much like the stock market, where you would trade with various stocks. You can also store your crypto on said exchange, but it is way different than storing the crypto on an actual wallet. Remember, if you don't have private keys, it is not your crypto, and on cryptocurrency exchanges, you do not get private keys since it is centralized. But it does have its perks. If the exchange gets hacked, if your PC gets hacked and you lose your funds, you can always call up customer support and maybe try and get your crypto back. Whereas if your PC gets hacked and you compromise your software wallet, your crypto is lost forever. There's no customer support to call. But I still recommend storing your crypto on a software or hardware wallet. It is always better to be the owner of your crypto and always be responsible. Never ever share your private keys with anyone. That being said, if you want to trade, you need to use either a centralized or a decentralized exchange. A decentralized exchange like Uniswap or PancakeSwap requires a browser wallet. Now, a browser wallet is the same as any other software wallet. You do get your private keys and it is your crypto. So it is pretty safe. And I do have crypto myself in software wallets on my browser as well. Never had any problems so far, thank God. This was supposed to be the basics. That's as far as I'm gonna go with the cryptocurrency exchanges for this particular lecture, because we'll talk more about various exchanges, centralized and decentralized, later on in the course. So you made it through the first section, or maybe you just skipped because you already knew what I talked about in section number 1. Welcome to section number 2, also known as trading platforms. Now in the first 2 lectures, the platforms I will talk about are not meant to actually put in trades, but rather to observe what is happening on the market. We will start with lecture number 1 with Tradingview. Now Tradingview is the absolutely best place to keep up with the cryptocurrency price action, and if you open tradingview.com and it doesn't look like this, it doesn't matter, it's totally customizable. This is just what mine looks like. Now this indicator down here is an advanced version of the RSI, the Relative Strength Index, and we'll talk a lot more about that later when I actually touch the topics of indicators. Right now I just want to go over the basic stuff, and also the candles are definitely not going to look like this once you open it up. As I said, I will talk about it later, but just to show you how to actually change your candlesticks, I'm looking at the Heikin-Ashi right now. Basically, you will probably see this, which is the normal basic candle. Some people prefer the normal candles. I personally better like Heikin-Ashi candles because you can see the trend a lot easier. Now, as I said, I will talk more about that later on, but as you open up TradingView, you can basically check any price of any stock or any crypto on it, basically just by clicking right here. But once you open up TradingView, it's gonna look like this, so nothing like the first screen I have showed you. So what you want to do is click on chart, because that's basically the most important thing. You don't even need to make an account, but it's preferred to make one. It's absolutely free making an account, but let's press on chart and see what happens. So it transfers me over to charts. It might not show you BTC right away, but if you click on this upper button right here and just search for BTC compared to USDT, because I want to compare Bitcoin to USD Tether and not normal USD. So this is the crypto version of the US dollar, so USDT, one of the crypto versions. We have USDC and we have many more, but USDT is just what I use basically for TradingView and just to look at a price action. Now on the upper corner, as you can see, since I have the premium version, I can even look at the 1 second chart and see how the price updates every single second. That's a little bit hectic and it's a little bit stressful to really look at the 1 second chart and just trying to make sense of it all. It's impossible. But when I open up a long trade, when I do futures trading, sometimes I like to have the 1 second chart just before I go into a trade, and just kind of to make sure that I enter a trade at the absolute bottom. So like right here. And if we go to the 1 minute chart, as you can see, it looks a hell of a lot different. If we go to 5 minutes, it looks a hell of a lot different. If we go to 1 day, it looks totally different as well. But it does look pretty good. Right now, the chart is looking pretty good. I don't know at what time you're going to watch this video, but the price is definitely not going to be $46,448 by the time you watch this video. So it might be lower, it might be higher. Hell, it might even be over $1 million per coin. I don't know when you're going to watch. Either way, that doesn't matter. For trading, we don't really care what the current price is. We only care about the upside or downside. We only care about the percentage. When it goes down 35%, we care about that. When it goes up 40%, we care about that. Now, how do you see what I just did there? How can you check the percentage of something? Now let's go to the 1 hour chart and just show you this real quick. On the left hand side, you will see this kind of a ruler thing, the measurement stick. You click the ruler and basically you just click at the beginning price you need and you drag it up to the price that you want and you click to confirm, and basically it says what percentage of an upside or downside, depending on what you want to learn, what percentage of a drop or upside that actually is. So that's how you do that. So basically TradingView literally has all the cryptocurrencies, all the forex currencies, the futures currencies, the stock market. So anything you need, from Tesla, Apple, Amazon, to Euro versus the US dollar, or the Great Britain pound versus the Japanese yen, to Cardano versus the Tetherless USDT stablecoin. So literally everything. Right, that's TradingView. So hopefully this was useful information for you. In case you didn't know, pretty much every other site uses TradingView as an embed tool to show people the candlestick price action. I have not seen any site use anything other than TradingView. So instead of going to Coinmarketcap to check for the candlesticks, or to go to PooCoin or any other one of those sites where you can see the price of a cryptocurrency, might as well just go directly to TradingView and just keep a lookout on the price action here. And I kinda, before I enter my trades, I always go to TradingView and I analyze the price. I don't trade directly on Binance or KuCoin or wherever it is that you want to trade. I just look at a price here and then I enter the trade at the exchange where I'm trading at that moment. Moving on to number 2, we have Coinmarketcap, one of the most useful sites I have found for cryptocurrency. I use it on a daily basis, and this site is owned by Binance as of this lecture being recorded. Now, when you go to CoinMarketCap, you will be greeted basically by this. This is the main site, and they also have an app for your phone, which I will show you later on the third lecture for the second section, where we will talk more about the watch lists and price alerts. And you really need your phone for that because it's way easier to keep up on your phone on the go wherever you are rather than being on your PC. Basically, you can see all the top cryptocurrencies listed by market cap. So the largest market cap, obviously right now being Bitcoin, is the first one here. If we go all the way down, we will have 100 coins on this list. This Nano right now being the 100th coin. With a market cap of $828 million. Obviously, 61 times 100 currencies is quite a lot, but yeah, that's all the currencies that are listed right now on CoinMarketCap. I'm guessing as time goes on, this list will only get bigger and bigger, but mostly what you want to look at is the top 10 cryptocurrencies because they dictate the market, especially Bitcoin. And as I said, I don't know when you will watch this video, but by the time you watch it, it may even be so that Bitcoin is not the leader and the Bitcoin's price action won't dictate the market anymore. But as for right now, the fact of the matter is Bitcoin is definitely dictating the price of all the cryptocurrencies and dictates the price of all the markets. So therefore, one of the most important things obviously is dominance. We have Bitcoin dominance at 44.2%, meaning that 44.2% out of all the cryptocurrencies in the world, Bitcoin is 44.2% of that. Ethereum is 18.9%, being on number 2. And on number 3, we have ADA Cardano, followed closely by Binance Coin or BNB, which has surpassed it in market cap by a few $1 million right now. The list still didn't update because this happened only recently. Cardano dropped a little more than Binance Coin did, but we will see what today brings. The list might stay the same, it might not. Cardano had a bigger upside this week of 44%, while BNB only had an upside of 15%, so I think that's why Cardano is still number 3 and Binance Coin is still on number 4. But one of the most useful features on CoinMarketCap is the portfolio and watch list features. Now, I'll talk about watch lists in the next lecture, but basically you can create a whole portfolio and maybe name it all my currencies. I will create that portfolio right now. You go to add, and basically if you have bought any currency that you're holding, rather than always checking the wallet, you can just, let's say 1 Bitcoin, let's say I have 10 Ethereum, and it would look like this, and I can just check the price of Bitcoin, price of Ethereum, how much I have gained, how much I have lost since I have invested in it, and obviously your whole portfolio being right here. So this is actually very useful if you have a lot of other coins, a lot of smaller coins. For example, if you have, let's say I have 1500 Stellar, let's add 50 Binance Coin, maybe 100 Ethereum Classic. So when you have a lot of coins like this, it's way easier to just keep track of everything right here, and I can see on the 24 hours here how the price has changed in which direction, and just much easier to follow everything right here on your main portfolio. Now, having a portfolio this large would be very nice, but yeah, this is just an imaginary portfolio. For this lecture, it's CoinMarketCap, but on your phone. The app is absolutely amazing, having price alerts and more of the watch list. Also, when you make an account, it's all interconnected and you can basically have the same watch list on your phone and on your PC. But basically you can click on watch list and create a whole new one, but I will not do that. But as you can see, it's pretty easy. You just pick a name, you pick a description if you want, either it's public or not. So you can't actually buy coins on CoinMarketCap, you can only watch the market. So let's say this is my watch list for some of the coins I wanted to buy, like Filecoin, Chainlink, Litecoin, Solana, Polkadot, Dogecoin, Binance Coin, Bitcoin, Aave, PancakeSwap, and TrustSwap. And basically what this is, rather than having it in my portfolio, which is something that I have already bought, this is the watch list for the coins I want to observe the price action of, right? So I can just pick the watch list, and the same as my portfolio, I can just look how much of an upside, how much of a downside it had in 28 hours, in 7 days, in 1 hour. It's pretty useful and very easy to track the market with it. So that's all I will say for watch lists. It's pretty easy, pretty self-explanatory, and very useful. Obviously, it works on PC as well as on mobile phones. Now, as for price alerts, I haven't found the option for price alerts on your PC, but on your phone, when you open the app, on the left-hand corner, you see price alerts, and that feature is probably one of the best features I have ever used. Basically, let's go back to Bitcoin. So the current price of Bitcoin is $45,992. So let's say I want to buy Bitcoin at $30,000. Now, just hypothetically speaking, I would put in 30,000 right here, set alert, and now as soon as the price goes to 30,000 or below, I will get an actual notification on my phone saying that it's below 30,000, and I know that it's my buy level, so I don't have to actually even observe the market. I can just wait for the notification. Notification comes, I go in, I buy it, and absolutely same thing goes for selling. If I already have Bitcoin, for example, and I want to sell it at, say, $70,000, I can just go 70,651. For example, I can just set an alert right now, and as soon as the price goes above the price I have entered, or the exact price I have entered, I will get a notification telling me that I should sell, or just getting a notification telling me that that's the price, and from that I know that I want to sell for that price since I have added a notification, right? So price alerts, watch lists, very useful feature for both. You need Coinmarketcap. I would recommend actually making an account for it. You don't have to, obviously it's all free, but it's much easier to make an account so you can actually use the portfolio feature, and it's just much easier to keep track of everything on your PC and on your phone, because whatever you do on your phone, it's directly shown on your PC, and if you, for example, add a watch list, a coin to your watch list on your PC, it's automatically shown on your phone as well. So very useful stuff. Centralized versus decentralized exchanges. Right now, I'm on a decentralized exchange called PancakeSwap. In order to trade here, someone needs to provide liquidity because it's completely decentralized. There is no central bank. There is no central organ, if you will, that will help with the funds. So people themselves need to actually give the funds in order for me to buy something on the exchange. If I wanted to exchange one BNB into US dollars or BUSD, for this case, the Binance US dollar. Obviously, I don't have that much in my wallet, so I cannot exchange it right now, but this is how it would look. This is how it would work. And in order for me to get the BUSD, someone needs to provide liquidity for both BNB and BUSD. So someone needs to put $480 and one whole BNB into a liquidity pool so that I and other people can actually trade. And the person doing that, giving the liquidity, also gets something in return for providing said liquidity, since when I pay the fee, when I do my exchange, I pay the fee to him. So that's in short how decentralized exchanges work. Obviously, there's a lot more. There's farms, there's different kinds of pools you can use. Some have a higher profit margin, some have a smaller profit margin. For example, here is BUSD and BNB. Anyone giving liquidity here gets 30.75% a year. There's a lot more that goes into yield farming, but we're not here to talk about yield farming. We are here to talk about trading. A centralized exchange would be Binance, Coinbase, and all those exchanges that actually have a customer support. If you can call their customer support, they're most likely centralized because they have a central entity controlling everything, giving out funds, and so on. That by no means does that mean that Binance is insecure. I myself trade on Binance most of the time when I'm using a centralized exchange, especially when I'm doing futures or leverage trading. But basically that is the big difference. One other difference being that a centralized exchange has its own wallet, whereas a decentralized exchange uses a browser wallet like MetaMask, or Binance have their own wallet now, the Binance Smart Chain Network wallet. So it's a browser wallet, it's an extension on your browser, and you can pretty much just put funds in here and use any decentralized exchange you want. So the exchanges work on various networks from Matic to Ethereum to the Binance Smart Chain and so on. But that's as much as I will talk about the yield farming and whole centralized decentralized concept of the cryptocurrency markets. So it's time to talk about the different types of traders that exist. Some people prefer scalp trading, some people prefer day trading, and some people prefer swing trading. Now, what is the best for you? What is the most profitable one? And how would you choose what exactly to do? Well, it really all depends on the situation. Some people like to prefer to themselves as one of those groups, but really what's the best thing is to consider all those types of traders and kind of doing all their moves depending on what the market does. A day trader would look at today's market structure, so just for the past 24 hours, and try to see where the trend is going to lead up tonight. So I would take a trade at the beginning or midday and exit the trade at the end of the day, looking to get some profit as much as I can. If you are doing spot trading, which means that you just buy a certain number of coins and you sell a certain number of coins once the price gets higher. If the price gets lower, you can just keep the coins up until the price gets bigger than what your entry price was. Obviously, you can also consider doing leverage trading, but that's something I will talk about in the next lecture. For this lecture, I just wanted to do a quick summary of what the different types of traders are. So scalp trading would be looking at the 1 minute to the 5 minute time frame and kind of picking out little scalps. Now, a scalp would be, for example, trading from here up to here. This is 0.30%, but this is a very nice scalp trade, especially if you're doing leverage trading. So a scalp trading would be recognizing this or recognizing stuff like this where you would short the downside on leverage trading, and 0.30% is actually pretty good when doing leverage. So I will talk a lot more about that in the next lecture, as I said, where I explain leverage trading a lot better. For now, that is scalp trading. You know what day trading is, and swing traders often use both fundamental and technical analysis for their trades, and the swing traders will most likely trade higher time frames rather than doing 1 minute time frames like the scalp traders. So let's go to the 1 hour time frame and see what a swing trader would do. A swing trader would look for entries right around this area here and kind of try to surf the wave up and do an exit around this area here. So this would be a nice little swing trade that would probably last a couple days to even a couple of weeks, and this is an upside of 10%, which is a lot more than the scalp trading. But then again, in this time frame, you can do 10 plus scalp trades, whereas it's only one swing trade. So hopefully you understood the difference between those types of traders and what the names are for the certain types of trades you want to do. And in the next lecture, we will be talking about leverage trading a lot more. So on Binance, it's called futures trading, and depending on what exchange you pick, it might be called something different, but all of this is just leverage trading. So let's talk a little bit more about leverage trading and how exactly can an upside of 0.3% give you any rewards whatsoever. Well, with leverage trading, you can pick what leverage you want to use for that said trade. So if a coin jumps 0.3%, it actually for you jumped times 50 of that. So if you use 50x leverage, which I would definitely do not recommend. So do not use 50 leverage, especially if you're new. Stick to 5 leverage to maximum 10 leverage if you're new. So even 5 is way more than enough. So if a coin jumps 0.5% and you have 10x leverage, for you that's not 0.5%, but rather a 5% increase in price or in profits. So to explain this a little bit better, let's say Bitcoin is $40,000 and that's your entry price where you put in a long trade. So long trade meaning that you predict the price is going to go up. You pick 10x leverage and you exit at $45,000. You enter the trade with $800, which is 0.2 Bitcoin at this point with 10x leverage, and your reward would be $1,000, which is 125% of what you put in because of the 10x leverage, right? But it also works in reverse. For example, if you put in a long trade at 40,000 and the price goes to 35,000, you would lose $1,000 rather than win $1,000. So it works in both ways. Leverage trading can be really tricky, and that's why I prefer to do scalp trading for leverage, and I never do swing trades or day trades for leverage. It's just too stressful for me, and I would much rather just do scalping on leverage and spot trade when I'm doing swing trading and day trading. So doing fundamental and technical analysis for buying spot, for actually buying the coins, and then just scalp trading for when I do futures and when I want to predict short-term price action. So I hope all of this was of some help. Now, next things we're going to learn is how to actually draw on the graph and how to do your own technical analysis, pretty much how to use the draw tools, the indicators, and so on. So let's do this. Now let's talk a little bit about the drawing tools. Finally, we can talk a little bit about the drawing tools. If you go to Tradingview, there's a couple tools on the left side, as you can see here, and really anywhere you look at a price, you will see those tools as well. So I'm gonna go over to the 5-minute time frame and kind of try and draw something a little bit. Because when I say drawing tools, for example, you have stuff like this where it makes easier for a content creator like me to show you what exactly I mean by just drawing around it. But it can be also very useful if you want to, for example, say this is where I entered a trade, and instead of looking at my exchange, I just want to look right here on Tradingview. So this is one way how you can mark where you entered a trade, or you can just do this, whatever you want. You can just use this freely. You can draw with this. You can say stuff like, right, but all of you have already bought the course, so this doesn't really make any sense. Then if you have written a lot of stuff like I have right here, it would be difficult to just delete everything and everything independently. So what you can do is right click, remove drawings, and boom, everything gets removed. Now we also have the trend line, which is way more useful. You can just click on the first place you want it to stick, and then move your mouse to the second place you want it to stick, and then just confirm, and we have a trend line right here. Let me remove the second one, and let's put a bottom trend line as well. I'm not really sure where to put it, to be honest, because the trend right now is looking a little bit, it's not looking set in stone yet. But let's just extend this, see to where it goes. Yeah, it kind of lines up with this, so this is all good. I'm gonna extend the upper one as well. And we have drawn a trend. Now we can see we're clearly in a descending trend, a descending narrowing wedge, because it is narrowing and it is descending, and this is definitely a bullish scenario where usually what happens in a descending narrowing wedge, it goes like this up until it just pops right back out. So that's what normally happens, and once you recognize a trend, you can just Google what it looks like, and most of the time you will see what usually happens when a trend like this happens to be on your chart. Obviously, if you right click on your trend line tool, you can see there's a lot of things you can use here, and pretty much everything here is just to make it easier for you to read the market and kind of recognize the trends. But what I found most useful for me is just the normal good old trend line. And one other thing I would recommend using is the ray. The ray is also pretty useful, whereas you click one, and then as soon as you extend it a little bit, it goes on. I'm not sure it goes on indefinitely, but it goes on for a long way. So this way it can make it easier for you at some points to actually like recognize trends, or even draw spider lines, which is something else I've learned throughout my years. But we'll talk more about spider lines over at my YouTube channel at inspectormindblow. If that's something you want to check out, be sure to do so, because in this course I will not talk about spider lines, because I do think for someone who is a beginner, they're not even that useful, because you first need to learn about trends, about normal trend lines, and about recognizing patterns. Now let's talk about basic support and resistance. What does that even mean? So let me first get rid of the trend lines I drew before. I'm gonna go over to the 4-hour time frame and kind of see where we have support, where we have resistance. Now here's a very good example of support and resistance. So the price was going up until it hit one point where it went a little bit sideways, which means that right here is the resistance point. It went down and it bounced from this point here, which means that this is a support line. So let me get my ray line, let me get my ray out, and I will kind of draw this resistance here in white, and then for this support down here I will make it red like this. And let's just kind of see just these here two trend lines, how they match up with the rest of the price action. So as you can see, this right here used to be a resistance before the price broke out of said resistance, which happened right here. And now once the price breaks out of resistance, it becomes support. So what happened here, it fell up until this line and it bounced off. Now unfortunately it kept going down where it hit the second support line and it bounced from there. Then it went down, it bounced again from the previous resistance, which is now again support, and it continued bouncing like that off the previous resistance, which is now support. So let's go to where the price is at right now and see if that has anything to do with our price action here. Obviously, it does a lot. As you can see, it even traded right here between our support and resistance lines. And right now we are at what used to be resistance and is now the support. So it should jump off of this price, but if it doesn't, it's definitely not going to go below this one. It is very, 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 very unlikely, especially looking at the RSI, which is almost in the oversold category on the 4-hour time frame. So if it goes to here, it will be way, way, way below the oversold barrier, which means it'll definitely go up from here. So I'm not even thinking it's going to go below the resistance we have right now, the support actually we have right now, but basically, that is how to use support and resistance. Most of the time, it makes sense. If you just draw support and resistance and just see if it lines up with everything on the chart, as it does right here, it totally makes sense to follow support and resistance to help you with your trades. Now, it's finally time to talk about the various candlestick patterns, and let me just remove my support and resistance from the previous lecture. Now, right now, I'm using the Heikin-Ashi candles because it just makes it easier for me to read the market. It's easier to spot the trend, and I can clearly see what is an upside, what is a downside, especially with how colorful and bright it is. But also for trading, you can use the normal type candles, which is what most people do use. For me personally, it's easier to recognize the trend with the Heikin-Ashi candles. As you can see, it's kind of hard when you look at it with your naked eye to just spot out the clear trend as it goes up, down, up, down, up, down, up, down, up, down, up, down, but not really, as it's been going up constantly, but you can't really see it because of the candles. So if you just switch to Heikin-Ashi, you can clearly see the trend going up. But then again, before putting in a trade, I will always look at the normal candles rather than Heikin-Ashi. Once I recognize the trend, once I know approximately where the price is going, I would turn back to normal candles just to kind of see how the price action is doing from hour to hour. Obviously, there's a bunch of different stuff you can use, like the bars, you can use the line, you can use the area, the baseline. So there's really a lot of things you can use, the hollow candles, for example, but I'm just not a fan of any of that. Most likely, I will just use Heikin-Ashi every single time of the day. So that's what I would recommend to you too, to switch from Heikin-Ashi to normal Japanese candles, and that's kind of the only two things you will ever need. So in trading, volume represents the extent of activity by market participants by accumulating the number of cryptocurrency contracts traded in a period of time. For each trade, the number of contracts traded is recorded and then incorporated into the volume chart. Now, the volume is this right here. Now, to explain it in much simpler terms, the more it is traded in a particular amount of time, the higher this volume candle will be. It is red when they sell more than they buy, and it is green when they buy more than they sell. So that's all pretty self-explanatory, and as you can see, a big green volume spike equals to a big green candle right here. If the volume is low, don't expect a breakout. If the volume is getting higher and higher, but the price is not falling down, expect a price pump very soon. Now we're going to be talking about moving averages. So we'll pick just the normal moving average right here. And this is a very important trading indicator and can be used to make your trades better and for you to take more profit. And it's also very easy to learn if you are a beginner. The moving average indicator is a way to calculate the average of an asset price over a specific period of time. The exact time is up to you, and it ranges from just a few days to even 100 days depending on how far back you want to track the price of your desired asset. Moving averages are actually great to establish support and resistance areas. So basically, when you see the price above a moving average, we are bullish. If we go below the moving average, as you can see right here, it didn't break through the moving average, and this is where we became bearish. Now, it did break to the upside, fell back down, broke to the upside, fell back down. So really, it all depends on what moving average you're looking at. And if we open this indicator section right here and we choose the settings for the moving average, you can see what the length of your moving average is. So for example, we can set it to 10 days. So this is the average of the price moving up and down. Now, let's introduce another moving average, and this one I will set to 50. Let me just change the color for easier visibility. I will place this as red and the other one is blue. So now we have a 10-day moving average in the blue color, and we have a 50-day moving average in the red color. And as you can see, whenever they intertwine, something very interesting happens. When the red one goes below the blue one, we turn bullish. But when the blue one gets below the red one, we turn bearish. So right now we are bearish, but it can very much easily shift in the direction of bullish. As soon as these two lines connect right here, they intertwine, we get the so-called golden cross, then we are turning bullish. So that's very basic moving averages for you guys. Now let me just get rid of the moving averages and let's talk about the relative strength index, aka the RSI. One of my favorite free indicators out there. So RSI, meaning relative strength index, allows you to calculate the recent price modifications on the market. The RSI will allow you to comprehend whether the present market is oversold or overbought by making use of this information. As a result, it's quite helpful figuring out when it will be proper to purchase or to sell. So as you can see right here, we entered the overbought area. Once the RSI exits this little area, we're overbought. Once it dips below this area right here, we are oversold. So what happened when we were overbought? The price tanked down. A lot of people were in profit, and that's what this means. So right here, we were oversold for quite a bit of time, but what happened after that? Well, the price still tanked down. So this is by no means the only indicator you should use, and by no means should you just straight up buy when you see that the RSI is oversold. Now, the RSI was oversold here because we had quite the crash and went from overbought to oversold very, very fast. So let's take a look at a better example right here. For example, here we hit the oversold area 3 times in a row, kind of solidifying that this might be the bottom, right? And from there, the price did pump up over 10%, so almost 15%. Also, as I said before, by no means and by no stretch of the imagination should you use only this, but the RSI can confirm a lot of things if you look at it. Now, the second thing the RSI is very useful for are bearish and bullish divergences. I was going to talk about this a little bit later when we go over the different patterns and whatnot, but either way, I will go over it right now because this is very, very useful. So what exactly is a bearish divergence? So look at the price right here. This is Bitcoin on the daily chart. As you can see, price is steadily going up. Now, if we check the RSI in that exact time, the RSI is showing a different story. The RSI is showing that the price is going down, even though the actual candles, the actual price is going up. So this is what you call a bearish divergence, and most of the time the bearish divergences play out and we do have a correction after those. So how big was the correction after this bearish divergence? Let's just see. This is a correction of almost 10%. So most of the time this is going to work out, especially if you look at the daily chart, 12 hour, 6 hour. But so you're going to want to look for bullish and bearish divergences on the longer time frames. Now, a bullish divergence is pretty much exactly the same, but in reverse. If the price is going down, but the RSI is going up. All right, ladies and gentlemen, time to talk about candlesticks. Specifically, we're going to talk about 15-minute candlesticks, 1-minute candlesticks, the 4-hour candlesticks, and then at the final lecture, we're going to talk about the difference between the types of charts. So we have the candlesticks, we have the line, right? We have the different types of candlesticks like Heikin-Ashi or the normal candles, right, or the hollow candles, etc., etc. Right now, I'm going to focus on the normal candles and kind of explain the difference in the charts. So right now, I am on the 1-hour chart. I will put it back to 15 minutes and explain what this is. Right now, the price is looking very choppy and very, very weird as of me recording this video. A lot of people are saying we are entering the bear market, but that is far from the truth. So yeah, technical analysis is very important. So what this means is that every single candle you see is 15 minutes. So this big downside was only 15 minutes long. Then this small upside was only 15 minutes, as well as this little small move was only 15 minutes in length. So how does it actually form? Well, the 15-minute chart obviously is formed by 15 candles from the 1-minute chart. So if you look at 15 candles here and then go to 15 minutes, that only forms this one candle right here, right? So the 15-minute chart is probably the most useful to look at after entering a trade and you want to kind of just watch and observe. That is the best chart that I look at for kind of just observing the market. Right, now back to the 1-minute chart. This is the one I use to kind of figure out when I'm going to place a trade. Now, looking at the 1-minute chart, the RSI is not that important. Well, it is important always. On the 1-minute chart, obviously not everything is as precise because we are looking at a very, very small time frame. Now, obviously, you can even look at the 1-second chart. The 1-second chart is very ridiculous. You're just moving up and down like crazy. See? It's insane. But back to the 1-minute chart, this is the one I will mostly use, the 1-minute and the 5-minute, to kind of see where I will enter a trade. And then once I enter a trade, like I showed you in the previous lecture, I will just go to 15 minutes and kind of watch, observe, and see what's going to happen. Now the 4-hour time chart, the 4-hour one is useful for predicting future moves, right? If you want to predict what's going to happen tomorrow or a week from now, you will never be able to predict it with the 15-minute and the 1-minute chart. It's impossible. But with the 4-hour chart or even the 6-hour and 12-hour charts, you will be able to easily predict the future. Well, not easily, but easier, I should rather say. On the 4-hour chart, the RSI is very important. And as you can see, the current price action is saying that we are bearish on the price action, but the RSI is bullish, so we're having a bullish divergence, which is very good, as you can see right here. So the 4-hour chart can predict things like that, and those things are very important. So the 4-hour chart is for longer term price action. 15-minute chart is mostly for observing what's happening after entering a trade, and then the 1-minute and 5-minute charts are the best for kind of figuring out where you want to enter a trade. Now the difference between various types of charts, I'm gonna go here to the 4-hour just so you can kind of easier tell what I'm doing. So we're looking at the normal candles right now. And basically, if there was more selling volume in a particular 4-hour period, the candle is red. If there was more buy volume, the candle will be green. Now, if we switch to the Heikin Ashi candles, that is not the case, right? Heikin Ashi candles are there to help us see where the trend is going, and looking at this whole chart, you can easily tell when it's going up, when it's going down. So Heikin Ashi is also great for kind of following the price action after putting in a trade, while the normal candles are way better, in my opinion, for telling when you're going to enter a trade. So all of this is mostly personal preference, and in my honest opinion, most of the time I use the lines, because the lines don't provoke a emotional response. They're not green nor red, it's just a line. And when you just see a line, it's much easier to tell where the price action is going to go, because it's not tied to any emotional bias whatsoever. Now, when it comes to patterns, I always want to show examples on the current charts, but sometimes it is just not possible. Like, for example, right now, as I was drawing up the pattern, it's already playing out. So we'll do something else, and I will show you this graph right here. And this is two graphs. So we have a bullish triangle and we have a bearish triangle. So bullish triangles are usually coming from the downside onto the upside, and these are called ascending triangles. And then we have the bearish triangles, which are called the descending triangles, and I would argue that this was a descending triangle right here for Bitcoin on the 5-minute time frame. So looking at this chart, a descending bearish triangle is supposed to play out like this. We go here, up, down, and then breakout is right here, and we continue going below. So this is exactly what is playing out right now, and it's always nice to see a pattern playing out just as I am showing you the pattern. So we have both bullish triangles and bearish triangles. Now, here's the difference as to how to actually spot them. So descending triangles usually have a solid support like this, while the upper side, the higher highs or higher lows, whatever you want to call them, whatever they actually are going on a descending trend. Then as for the bullish triangle, we would need to have the support zone, or rather the resistance zone, on the upside like this, while the downside, or the lower lows and lower highs, are forming an ascending trend. Now in this case scenario, we would need to come from the downside, hit the top, come back down, hit the top, make a higher low, hit the top, make a higher low, and then the breakout point will be around here, and we'll continue going up. Now, if you spot any of these patterns, this is how they play out most of the time. Now here we have something called a wedge. This is a symmetrical wedge pattern, right? Wedges are similar to triangles, but they are not triangles. You need to differentiate wedges and triangles. So this wedge pattern, the symmetrical wedge pattern, could go either to the upside or to the downside. So it could go either way. And the height of the wedge, of the largest point of the wedge here to the left, is how much the price usually breaks up either to the upside or to the downside. Now the key difference between triangles and wedges is that the triangles usually have a clear support or resistance area. So a triangle would be just a clear line like this, and then for a bullish triangle, we would have the lower part kind of go like this with higher lows and higher lows. While if this is not a clear straight line and it goes either way, like it can even go like this would also be a wedge. Most of the time it's a symmetrical wedge like this, and that is the main difference between wedges and triangles. So a wedge is playing out a little bit similar to the triangles, as when it comes from the downside and starts going down like this, it usually breaks to the upside. This is an uptrend wedge. Now if the same wedge was to look like this, where you would put higher highs and higher lows rather than lower lows and lower highs, you would not have a bullish wedge, but rather you would have a bearish wedge, and the pattern would go down. You can pause this lecture at any moment, just take a screenshot of this. This is very, very useful. Or you could always just Google different wedge patterns in stocks or crypto. Now it's time to talk about bull flags and bear flags. First of all, we're going to talk about bull flags. So what exactly is a bull flag? Well, this right here would be a bull flag in an uptrend. So we have a huge upside, a little wedge going down, and then another upside. This flag can be represented either in a triangle or a wedge. So let's take Bitcoin as an example right here on the daily chart. One would argue that this right here was a bull flag. So one upside, one downside, and another huge upside. So this is clearly a bull flag. But as it kept going up and making the higher highs, lower lows, higher highs without having a bigger upside, or without going a little bit down at least, this was a clear indicator that there was going to be a correction, and there was a correction of 25%. So quite the correction. And in case you want to know how to measure the percentage on the left side of Tradingview, you have this measurement stick, as we talked already throughout the course. But just in case you forgot, you have the measurement stick right here, aka the ruler, and you can just pick a location where you want to start, go to the location where you want it to end, and you can see the upside here would be 33%. Now, a bear flag is the direct opposite of a bull flag. So I wasn't really able to spot a good bear flag to show you here on the chart, but maybe we can look at this as an example here. So we have a downside, we have a slight correction to the upside, just like we would have a slight correction to the downside for a bull flag, and then a continued downtrend. So something like this would be considered a bear flag. But looking here at this chart, maybe it's a little bit easier to show you how to actually confirm a downtrend for a bear flag. So one downside, then continue going up a little bit up with higher highs, higher lows on lower time frames, and even on the macro, on the bigger time frames. Then we would clearly see a continued downtrend, because this is a bear flag. So it can either be a wedge right here or a triangle. It really doesn't matter. Now it's time to talk about one of my favorite patterns called the shoulder head shoulder pattern. And we're also going to talk about the bullish difference with the reverse shoulder head shoulder pattern. But first, we're going to talk about the bearish one called just the shoulder head shoulder. And I do have a good example here on the Bitcoin chart on the daily. We had here, first of all, this was a new all-time high, pulling in a shoulder. Then we had a higher high, which is very important because this is the head. And then we have another lower high than the head, confirming a third, actually a second shoulder, and confirming the shoulder head shoulder pattern with a continued downtrend. Now the downtrend could be represented later in a bull flag or a bear flag actually as well, but in this instance, this was not the case. So let's look at some other examples here. We usually have the left shoulder, then we have something called the left valley, then we have the head right here. A head is higher than the left shoulder and is the highest point in the pattern. Then we have the right valley, and then the right shoulder needs to be lower than the head but higher than the left valley. So as you can see right here, the left valley would be right here and the third shoulder would be right here where I already put this in. So it is higher than the left valley right here, which does suggest that this is a shoulder head shoulder pattern. Now, how would you trade this? Well, you have something called the neckline right here. I would probably say the neckline is somewhere around here, but it can be measured also from the valley. So we can go from here and just put a straight line from the left valley. And one would argue that this is the neckline. So you would trade from here in case it confirms the shoulder head shoulder. So you'd be able to trade right here like this. Now, the reverse shoulder head shoulder pattern is a bullish pattern, so it's pretty much the same but in reverse. Here's a very good example of how a reverse or inverse shoulder head shoulder pattern plays out, or just head and shoulders pattern, whatever you want to call it. So we have the left shoulder, then we have the head, which needs to be lower than the left shoulder in this case, and then we have the right shoulder which needs to be a little bit higher than the head. Then once it reaches the neckline right here, we have a breakout confirmation, and right around here you would be able to place in a trade knowing that it would definitely go to the upside in most cases. So here's another good chart showing both a head and shoulders pattern and an inverse head and shoulders pattern. So neckline would be right here, breaking to the downside, pulling in a reverse head and shoulders, the neckline being right here and pulling back up to the upside, having the same price as before both of the patterns even occurred. You need to be able to differentiate bullish and bearish patterns. Now, for this example, I've set my candles to be gray and green, mostly because I don't like the look of the red candles. They make me emotional and they make me do bad decisions. Now, if you want to do that yourself on Tradingview, you can literally go here to settings, and here under these three options right here, you can choose the look of your up candles and the look of your down candles, or the color rather. So it would be red per default, but I set it to gray. So with that being said, let's try and see how to spot a downtrend versus an uptrend. So first of all, I will put my candles to Heikin-Ashi candles. Now, obviously the Heikin-Ashi candles I have not changed. They remain green and red. Now, this way it'll be somewhat easier for us to spot an uptrend versus a downtrend. So what would a downtrend look like? Well, basically putting in lower lows. So that's a lower low, and this goes even lower, and the lower low, and the lower low. So that's one of the ways to find a downtrend. Lower lows and lower highs mostly is a downtrend. So looking at this, we would be able to see that it might still continue going down since we are on a downtrend. Now, once a downtrend is stopped and we make a solid ground, like for example right here, so here we made some solid ground, this wasn't a lower low. Now this part right here might be called somewhat of a diversion, something we did not expect, something that doesn't go anywhere in the technical analysis. So things like this are hard to predict because this right here was mostly long liquidations and this right here was mostly short liquidations. So either way, we see that right here we have not put in a lower low, but it is mostly the same level as the previous one. So from here, we might expect an uptrend. Now, we're still not in an uptrend. Once we are, we're going to be able to clearly see it, like right here, because we pull in higher lows after higher lows after higher lows, and higher highs after higher highs after higher highs, and so on, until we stop somewhere, put in a solid ground, and then maybe go into a downtrend. So basically, that is bullish versus bearish trends. And just looking at the chart like this, you need to be able to clearly see when we are in a uptrend and when we are in a downtrend. Now, based on that, how do you choose an entry point? Well, mostly for me, I like choosing my entry points based on various patterns. So for example, Bitcoin right here made a somewhat of a cup and handle pattern right here. And as for a cup and handle pattern, you gonna wanna trade the neckline, which is right here. So the neckline or the upper part of the cup and handle pattern. So that would be somewhere around here. And this is how you would normally trade it. So let me actually go back to my normal candles and let's draw the cup and handle. And now what would be the upper part, aka the neckline, would be somewhere around here. There we go. Now, how would we trade this? So basically, I wouldn't touch the cup, I wouldn't touch the candle, I would wait for the breakout, which has happened right here. Now, I would not trade the breakout directly, I would wait for the breakout confirmation. So this is on the daily chart. If we go back to the 1 hour chart, and let's kind of see here, where did the breakout happen? So clear breakout happened right here. It did break out and it broke out very, very fast and very, very aggressively. Now, I wouldn't have traded any one of these candles right here. I would have waited for the breakout confirmation, which did happen right here. It needed to come down and test the breakout or the neckline or whatever you want to call it. And once it has been tested and successfully defended, I would have placed in a long trade anywhere around here. Just anywhere around here where the breakout has happened, and I just would have ridden the wave to the upside and sold somewhere along the way. So what exactly is a breakout? We've already talked about that in the previous lecture, but taking a look here at Cardano, which just had a big breakout. So a breakout would be anything that resembles this. Any massive upside will be considered a breakout. Now, the breakout we are looking for is when a breakout happens after the price action exits a certain pattern, right? So for example, when it exits a cup and handle pattern, which this wasn't, but just giving a short example here, this would be the breakout of the cup and handle, which we would want to trade. So let's see here, we clearly had a big support and resistance area for Cardano for this level right here. So let me put a very bold line over it. So this is the area of resistance, which now that we had the breakout, it's going to become, actually it already became an area of support. Now what we want to see is for Cardano to test this, to bounce off this and successfully test it as a support zone, because previously it has been a massive resistance, getting rejected once, twice, that's 3 times, 4 times, 5 times getting rejected from the same area, and we are looking at the 30-minute time frame right here. So that is a breakout. Now, how would we trade a breakout confirmation? So just like the lecture before, let's put the very basic support and resistance line right here, which is this right here, the support and resistance area. So what we are waiting for right now is for Cardano to come back down and retest this as support. So maybe it's not going to happen, maybe it's not going to go all the way down, since it did have quite a big upside, but then again, we would not want to trade this coin if it doesn't have the breakout retest. Only trade it when you have the breakout retest and when it's successfully retested and another candle finishes above the new resistance zone, and then is when you want to place in your trade, because after the successful retest it will continue going back up and you have yourself a nice little trade. But looking at it here, it doesn't look like it's going to come back down all the way to the new support zone. Maybe at some point in the future, but it doesn't look like it's going to happen today. It's suggesting that we are looking here at another support zone for Cardano, but basically the breakouts you want to trade are the ones that retest the previous resistance, now support zone. Now, another thing you want to be on the lookout for is the current price and the volume whenever trading a breakout or a breakout confirmation. So a breakout confirmation would be the successful retest, right? So that's a confirmation of the breakout retest. And a breakout is just this upside from a previous resistance area, which we already covered in the previous lecture and the one before. Now, why do you need to look at the volume? Well, as you can see right here, the volume has been going up, and then it's starting to fall down, which suggests that the price is slowly and steadily stopping in its tracks where it is right now. And that might be due to a couple factors. For example, the upside was quite big right here, over 10%, I think. Yes, exactly 10% actually from this candle right here. And so a lot of people are in profit while we are in the overbought area for the RSI, which is never a good sign. But then again, looking at it from the money flow perspective on my birdview indicator, which if you do want to use code inspector20 on birdviewtrading.com. So you use code inspector20 and you get a 20% discount. Now we have a couple other indicators for birdview, but I don't think these are necessary just to trade the breakout confirmation. You can do without any of those. What I really use mostly is the money flow, looking at the volume, looking at the RSI, and looking at the price. Now, why is the price important? Well, we have certain psychological levels which are very important. For example, the 1.7 area is a great psychological number where a lot of people will have placed their stop loss or their take profit. Same goes for any area that is exactly $1 or $69 or $69,000 and so on. So you need to look at the price and really see where the psychological areas are, where a lot of people will have placed stop losses, take profits, etc. So while trading the breakout confirmation, you also gonna want to look at the volume. We want to see a volume going up. We want to see the volume spike going higher and higher, because that is another confirmation that the price will continue to go higher. Now, if you look at the 1 hour chart, we definitely want to see this volume spike be higher than this one in order for the upside to continue. Now, obviously, it doesn't have to be that way. We do have exceptions, but if you see all the signs pointing that the price is going to go up, most likely it will go up. Don't get confused about the prices here. It's been quite a while since I recorded the last session, so I came back here just to finish off this course. So in order to understand long-term investments, you don't even need to look at the technical details so much. Of course, for trading, for short-term trading, for scalp trading, and for trading breakouts, of course you need to know technical analysis. But for long-term investments, fundamental analysis is the most important thing, and that is something you cannot find on the charts. Of course, you can use technical analysis in order to find the best entry for you, but as far as long-term investments are concerned, you need to look at the fundamentals as to what the actual coin does, as to what the project does. Is it going to be useful going on? Is it going to be useful in the future? And then once you find a project that you really like and you like their mission, you like their idea, then you would go to the technical analysis and try to find the perfect entry for you. You will never be able to time the bottom. No one times the bottom well. That is where the long-term investments come in handy. Let's take, for example, the previous bull market. So you found Bitcoin, you love what it does, you love Bitcoin overall more than any other coin. And now, could you time to enter right here? That would be probably impossible. But if you bought here, or if you bought at these levels, or even if you bought at these levels here, it doesn't matter. You would still be in profit once Bitcoin reaches its all-time high. Now, as for selling, it is a totally different beast. You can also never time the exact top. But if you're in it for the long-term investment, and you invested anywhere from these 3 points that I pointed out, you would still be in profit. Even after Bitcoin fell, even after the bear market, you would still look at your portfolio and you would still be in profit. But even if you weren't in profit, even if you invested a little bit higher up, a long-term investment, for a long-term investment, it doesn't really matter, because if you're in it for 5+ years, who knows where the prices will be by then. And that is why it's so important to do the fundamental analysis and see if the coin, if the project can really withstand the test of time, and if it still will be relevant 5 years down the road. As far as choosing a low market cap coin, and I will try a few here. For example, we have Illuvium. This is a lower cap altcoin, and you can go to the website Coinmarketcap. It is owned by Binance, and here you have a list of all the coins. Now here you will be able to find lower cap altcoins. Once you find something that looks interesting, you can click on it. Now this is not really a lower cap, it's still almost 2 billion. It's fully diluted market cap. This is not a low cap altcoin, but just for example's sake, you can scroll down and see what this coin represents, what it is. So what is the Sandbox or the Sand token. So launched in 2011 by Pixel, the Sandbox is a blockchain-based virtual world allowing users to create, build, buy, sell digital assets, etc., etc. So here you can learn about the project, read more about it. You scroll all the way down and you can even see on which exchanges it trades on, so you can invest accordingly on your favorite exchange if it is available on your favorite exchange. Now, if it is a long-term investment, as I said, it doesn't really matter at which prices you buy at, because if it does withstand the test of time, it will most likely be going up in price for an extended period of time down the road. So for example, Illuvium here, it is over 90% down since its all-time high in the bull market. Does that mean that the project failed? Not at all. If you look at the fundamentals, you will see that the team is still working, the team is still building, the team is creating something really good here. Then I'm just giving a really broad example here. You really need to find your own long-term investment. I'm not invested in this. It is just a random example. I cannot stress that enough. But that is how you find low-cap altcoins. You really got to search for them and you got to do your own research and due diligence, and then also come back to the technicals and really see where you would want to enter and how long you want to hold it for. So for example, sticking with Illuvium here, if I invested right now, where would I exit? I would look to exit before its all-time high. I would look to exit probably around these areas here, because as we can see, there is resistance. There is huge resistance here. I would look to sell here, but still from the areas now up until this point here, we have 800%. So that is where the altcoins really shine through. The low cap altcoins can really be big gainers, but they can also go to zero. So never underestimate how fast an altcoin can go to zero. Be on the lookout. And if you ever do invest in the low cap altcoins, be sure to have an exit strategy and never invest more than you can't afford to lose. Now, what makes good tokenomics? Going back to our example here, the Sandbox on Coinmarketcap.com, we have our circulating supply, our maximum supply, and our total supply. In this case, the maximum and total supply are one and the same, being 3 billion coins. Our circulating supply is roughly 50% of that. Now, why is that? Well, the Sandbox is still staking. The Sandbox is still creating new coins, as is Bitcoin, as is Ethereum. The difference is Ethereum can go on forever. It can mint as many coins as possible forever. Bitcoin is hard capped at 21 million coins. So the Sandbox has something similar, with 3 billion coins being its upper hard cap. That is the most it can mint. And the way I would look at this is try to find their white paper and really see how much of these coins will go to their team, how much will go into marketing, how much of these coins goes where, and try to find a really good project that doesn't give too much to the team. The team getting too many coins is always a red flag for me, because that is how rug pulls happen. It doesn't necessarily have to be all the time, but that is most of the time how rug pulls do happen. They need to invest some of these coins into marketing. They need to invest some of these coins into their treasury, and of course back into the ecosystem, rewarding its players if it is a game. Like in this case, it is a game. So you made it to the bonus content. Let's try to draw on Bitcoin here. It is very easy to do this right now, because Bitcoin currently, as I'm looking at this, is at a crucial resistance point. So here we go. I'm just looking at the daily chart right here, and as you can see here, this was a support zone. Then again, 2 times we had a support zone at the same levels. Then we had a sort of support, but it broke down below. And so what is it now? If you've learned anything from this course, you would know that this right now is a resistance. So let's draw a line right here at the previous support, which is now the resistance point around $30,000. And let's look at it here. Bitcoin is definitely at these levels right now. Very crucial point. And as you can see, it is working like a charm. It broke above this point, and now it is acting as support once again on the shorter time frames. Now that doesn't have to mean anything for the bigger time frames, but for right now, this is the zone. This is the area I would want to look at. And we can do a couple more things here. I can go here and pick a Fibonacci retracement, and here we have the Fibonacci retracement, and all I would do is go from the bottom of this bear market all the way to the top of the bull market, which was 69K. And here we have the Fibonacci golden zone. Now, if you draw your own Fibonacci, it might not look like this. So you want to go to the settings and just enable these 2 areas. This is the golden zone between 0.618 and 0.786. So this is the golden zone of the Fibonacci. Everything else is not as important. Let me just stretch this out a little bit further. There we go. And now we can even go to the lower time frames. But as you can see, Bitcoin is definitely using this as a sort of support zone right here. It was supported 2 times, and now it is going toward the upper part of this golden zone Fibonacci area. So these are some of the areas I would look at right now, and this is how I would do it. Draw support and resistance, draw Fibonacci's, and also the basic support and resistance zones. Very, very basic things, just trend lines, just this. This is a trend line right here. And so in order to figure out a trend, shouldn't be too hard figuring out a trend. You can see, is it going up? Is it going down? Currently, we are in an uptrend. Very easy to figure out. You put the lines, the trend lines at the lowest points it touches. And currently, we are sitting on this trend line. And now we can also do the same thing for the upper section. And let's try to make this make sense like this. Just it needs to touch all the sections up there. So let's just make sure that it does. And it does. It touches all the sections here. It touches this one here. Touches these here. But it also touches this one here. So this looks good so far. And now let's take a closer look at where we're at with the price action. I will just change the color of this big support zone, support and resistance zone here, and make it red. And as we can see, all right, now we have a clearer vision of what is happening here. Bitcoin is almost going back down into this trend, into this uptrend that was going toward the upside. What really needs to happen here is for Bitcoin to break above, retest, which it is doing right now. But after the retest, we need to continue going back up. If we break below, we will break below both of these trend lines, meaning very good short opportunity until the next support zone, which is right here. Now with the trend lines, you can easily figure out what the next price move will be. Once it breaks up or it breaks below, you can know where it is going to go next. If it does break below, very easy short. Then if it gets supported at this zone here, very easy long toward the next resistance zone, which would be this one in that case. So very easy to figure out trends. Following the trends is a very, very important thing when doing technical analysis for cryptocurrency. So as I said multiple times, rather than just going randomly in a trade, you want to trade the breakout. So this in this case is the breakout, but this is not where I would put in a long trade. I would wait for the confirmation. Now, again, this is the 4-hour chart. Depending on if you want to do a scalp trade, a day trade, a swing trade, you need different strategies. So let's go to the 15-minute chart and kind of see what happened here. All right, on the 15-minute chart, this is telling us a story right here. Let's draw up some trend lines and see where the trend was going before. So it definitely was going like this. It was in an uptrend. We can definitely see the uptrend happening here. But let's try to go even further back and see what exactly happened here. Here we were in a triangle shaped trade. Actually, never mind. It wasn't a triangle. It was more of a wedge. But here is how I would trade this breakout. So we had a wedge here. And if you drew the trend lines right here, you would have seen that we had a breakout right here. So this is the breakout that you would have been able to trade. Now, how would you know if it's not going to fall down? Well, you draw support and resistance lines, and you see, and you can then easily tell that we have a support line right here, meaning that the breakout will get supported. And if it does, and in this case it did get supported, we can trade this breakout and we would be able to trade it all the way up. So that is how I would trade a breakout. First of all, establish support and resistance zones, establish where the trend is, and wait for the breakout, then wait for the breakout confirmation, and then I would put in a trade.